Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes. This is episode 128 on the VideoCast, 118 on the podcast for the week ending March 31st, 2022. Welcome to the end of quarter. You saw what rebalancing looks like today into the close. Looks like a pretty weak close. I wouldn't make too much of that. Choppy Q1 it was. I love how we're set up for Q2. I think it's going to be one of the best ever, and we're going to go into some reasons why in this VideoCast podcast. So I want to say I've got some good feedback. By and large, overwhelmingly, people love the Ask Me Anything questions. There were a few people that didn't like it quite as much and suggested that the questions be put at the end of the VideoCast podcast because we've been just getting more and more and more. And this way, the people that just tune in for my commentary, can listen for the first, whatever it is, 45, 60 minutes. And if they don't want to hear the questions and answers, the Ask Me Anything, they can just tune out. And if they do learn a ton from it, which I do think there's a lot of great lessons in those, they can stay as long as it goes. So I think that's a good compromise, and I appreciate all the feedback this week. So we'll kick it off with the media real quick. Want to thank Ellie Terrett, Lauren Simonetti, and Liz Clayman for having me on the Clayman Countdown last Friday. We'll go into that in the article of the week. Want to thank Allie Thompson, Jovan Collins, and Alicia Nieves for having me on Cheddar on Monday morning to talk about inflation, to talk about the peak in oil, which happened to be timely. So a lot of good things there. And I want to thank Bansari Kamdar and Amruta Kandakar for including me in their article on Reuters this week. I was talking about, expect some choppiness into quarter end with end of quarter rebalancing, and the market's needing to consolidate some of the gains, digest the potential inversion of the 210 spread, and the possibility of a negotiated settlement moving forward, which doesn't look like it today, but tomorrow's always a new day. Quote of the week from Benjamin Graham: "The intelligent investor is a realist who sells to optimists and buys from pessimists." So if you followed this in recent weeks, you were selling the energy that you bought in 2020 and some of the banks earlier on in the year, and then you're buying from the pessimists. Well, that means you were buying Chinese stocks and you were buying biotech. So we'll talk some about that. This article by Sam Rowe, he used to be at Yahoo. I think he's at Axios now, and he has his own thing here called TKER by Sam Rowe, TKER.co. He wrote one of the most important articles I think you'll ever read on the stock market earlier this week. And I know this stuff. I've seen Peter Lynch's speech where this came from, but it was just phenomenal. So he lays out Peter Lynch, legendary stock picker who ran Fidelity, market-beating Magellan Fund for 13 years, made a prescient observation he gave to the National Press Club back on October 7, 1994. It comes around the 38-minute mark of the video. He said, "Some event will come out of left field and the market will go down or the market will go up. Volatility will occur. Markets will continue to have these ups and downs. Basic corporate profits have grown about 8% per year historically." So corporate profits double about every 9 years. The rule of 72. 72 divided by 8 equals 9 years. And the stock market ought to double about every 9 years. So I think the market is about 3,800 today or 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they'll go. So the market ought to double in the next 8 or 9 years. They'll double again in 8 or 9 years after that because profits go up 8% a year, and stocks will follow. That's all there is to it. And really, that is all there is to it. The key is, and by the way, that's exactly how you should be analyzing companies as well. That's why we like to buy durable long-term businesses that have a proven track record of earnings power, so we can have a sense of how quickly do they compound capital, how quickly do they grow earnings over a cycle, over a trend, and you can take a reasonable estimation plus multiple analysis, ranges of multiple analysis over time, and see when things are trading cheap, when things are trading expensive, and place your investments accordingly. So you can go ahead and read this whole thing, but it really nipped it in the bud. This is a great chart where it shows every single drawdown in the markets since 1980. You can review that and just see how normal these just average intra-year drops are 14%, and annual returns were positive in 32 of 42 years. So these average drawdowns, we just had a 12% on the S&P. The average is 14%. Profits go up 8% a year. You can use this exact same type of trend line for an individual company, and that's all you need to know. And that's what gets the noise out of your head when everyone's panic selling and forced liquidations and earnings keep going up. The stock will catch up to earnings over time. That's just the way it works. Moving right along, this is how Boeing 737 MAX will be flying in China. Investors are still waiting for the 737. This is from Al Root at Barron's. Waiting for the 737 MAX to return to commercial service in China, the last significant geography left to resume passenger-carrying MAX flights. A line from an annual report filed Wednesday gives investors an important hint of how resumption might finally happen in the country. Came from China's Southern Airlines, ZNH. The company said it plans to add 39 Boeing 737 MAX to its fleet in 2022 and 103 by the end of 2024. That's it. That's the update. And analyst Jefferies analyst Sheila Kahiglu pointed out in a report Wednesday that China Southern's expected MAX deliveries are actually down from a year ago, when the airline expected to take 48 MAXs in 2022 and 123 over the 3-period ending 2023. But it really doesn't matter. The key is that they're obviously, wired in with the government. The key is that they're taking some. Once that recertification goes through, I kind of surprised how off the Boeing CEO was about the timing, because it was supposed to happen before the end of last year. Nonetheless, it will happen, and this was the signal from China Southern Airlines, which has been using their planes for since 2009. This came from Paul Smith, who's an avid listener and viewer of the VideoCast each week, and he posted this. Tom, here we go again on Twitter. ASL orders up to 20 additional 737-800 Boeing converted fighters to drive environmental sustainability. Boeing says agreement is for 10 firm orders and 10 purchase rights. Second was another one. China Southern plans to take 103 Boeing MAX deliveries through 2024. China Southern to take 39 Boeing MAX deliveries this year. So their intent and their business plan is that the Chinese government is going to recertify it, and probably in relatively short order. So let's move on. The big change this week was Russia says Donbass is Ukraine focus in possible shift in aim. So they didn't get to any negotiated settlement this week, but it narrowed it down. Russia, like I said, neither of them have an edge, or they wouldn't be talking. They would just be taking. So they've kind of narrowed it down to the Russia separatist regions, which we've talked about for the last 3 weeks. This is likely what would happen. And at the end of the day, Putin will get some sliver of areas that don't consider themselves Ukrainian. He'll go back, throw a parade, declare victory, and recalculate in his mind how he so badly miscalculated what would happen when he went in. But nonetheless, that's how it plays out, and that will be a positive for the market. Will it be in days, weeks, or months? We don't know. We take the under. We think it's going to be sooner rather than later. Biogen files the final design for Agilem's post-approval study. This is regarding the Alzheimer's drug. So this is just another step in the process, but it's worth noting because we're seeing more and more positive things come out on biotech, which had been left for dead, one of our top 2 positions with BABA. And BioNTech's top earnings estimates, plans to do a buyback and a special dividend. They all have tons of cash on their balance sheet. As we stated weeks ago, there are over 100 companies trading at a discount to the cash, no credit for intellectual property, no credit for R&D, no credit for sales. And it's just an overshoot of extremes like we see in all different sectors at all different times. So, and we take advantage of it, and we sell to the optimists and buy from the pessimists. That's the key theme here, and it's nice to see that stuff. So today, the big headline was, this is different. Biden's budget calls for an increase in defense spending, and also the war in Europe is how the war is reshaping how Europe spends. Military spending is rising across the continent. There is a long-term peak to trough defense spending cycle. It's now in its trough. It's going to tick up. Even if this is resolved tomorrow, you're going to see a massive amount of defense spending across the world, which is why we've been so focused on defense stocks for quite a number of months. We've been talking about them, and we added another one, European-based, because we've been looking for European stocks. I'll even narrow it down a little bit more. We're almost at our full-size position, but it's not going to be anything like Baba or biotech, but it is a serious position, around 4% right now. It's defense and commercial aerospace based in Europe, and we're pretty excited about that one. So we've covered quite a few. Boeing will benefit. Lockheed, that is stuff we started covering last September, but we think that trend is just beginning. Disney, Bank of America bullish on Walt Disney's theme park recovery, received strong attendance for 2 years. I talked about Disney on the Clayman Countdown 2 weeks ago. I think that this is going to continue. Everything reopening is going to continue. That's the bottom line. We're going to cover an airline, a European airline, in the Ask Me Anything questions at the end of the podcast VideoCast, and we'll dig in a little bit more. The big news today was the announcement that the Biden administration is going to release about 1 million barrels a day for just until the election, to get the price of oil down so they don't lose too many seats. It's literally till the election. It's a 6-month plan, no coincidence. And which 1 million barrels a day is a lot, and that's going to be 180 million of, I think we've got 560 million in the strategic petroleum reserves. Not a great strategic play to make in terms of national security in the midst of a war that could, low probability but potentially escalate. Not in love with that, but it's one way to get it down. It's one way to put some leverage on OPEC. It's one way to maybe give Russia a little bit less flex in what they're asking for. And it's interesting because it was the last administration, if you remember, when energy prices were trading negative, that the last administration filled up the Strategic Petroleum Reserve, which was underutilized and had a lot of storage capacity, filled it up to the brim at low prices. And an example of buy low, sell high. Love that administration or hate it. They understood what it takes to get rich, which is buying when it's out of favor. And now, in the case of Biden, he'll be selling when it's in favor. So kudos to him. Maybe our government got it right. They bottom ticked and now they're top ticking. Maybe they should start a hedge fund together. The Trump Biden Capital. Trump will do all the buy orders and Biden can do all the sell orders. That would be something. So it's amazing how commerce brings people together from all around the world, regardless of ideology. Nonetheless, Biden sets 1 million barrel a day. Okay, so the key thing here also I wanted to mention, they're making this point that Jen Psaki has faulted oil producers for sitting on 9,000 approved but unused lease permits on leased federal lands. The industry defense is not every tract is a viable drilling target, and that other White House moves like canceling the Keystone XL pipeline have made executive investors worry about putting money at risk in any new projects. And this is a complete red herring, by the way. This idea that they have all the leases that they need, because if you recall, right here. This is what they did on day one. Revoking the March 2019 permit for the Keystone XL pipeline. And number two, which you can't even get this, by the way. You used to be able to get this on the same website, whitehouse.gov. It looked exactly like this. Now, all they have is a button to a PDF, so you can't search by the text. And right here, this was January 27th. Oil and natural gas development on public lands and in offshore waters. To the extent consistent with applicable law, the Secretary of Interior shall pause new oil and natural gas leases on public lands or in offshore waters pending completion of a comprehensive review and reconsideration of federal oil and gas permitting and leasing practices in light of the Secretary of Interior's broad stewardship and responsibility over public lands, offshore waters, including potential climate and other impacts associated with oil and gas activities on public lands in offshore waters. So look, this is self-inflicted. If the oil companies have so many leases that they're not using, then why did you have to shut it down? Because if they've got so many that they're using, why would they apply for new ones? Because the ones they have are not productive areas. That's really what it comes down to. So there was no need to shut it down if they had more than they needed to start with. And so it's a complete red herring. This is just a game for November. But nonetheless, leaving that aside, as much as people say it's a short-term solution and it won't make much of a difference, it will make some difference because it's over a sustained period of time, which is 6 months. And if you remember, the rig count is up now some 170% off the pandemic lows. You add another 6 months to that, the rig count may be back up to or nearing pre-pandemic levels, and with it could be an interesting bridge. In some sense, this is displacing the need for an Iran deal for at least another 6 months. Now, if you got this plus a resolution in a negotiated settlement in Russia, plus then an Iran deal on top of it, you could see oil drop to $65. I mean, pretty quick. And then you'd have, on top of that, the rig count would be building because this stuff doesn't happen overnight. It's already in the works. You add some type of ESG hiatus, where pensions and other companies say we will not pressure banks to stop lending to fossil fuel industry, this is a time of war or some type of emergency act, and the supply would come back on. But this is the point that I'm making is this is all self-inflicted. As a matter of fact, this from Zero Hedge says Biden unveils response to Putin's price at the pump, big SDR release, and basically what Goldman is saying is this move to reduce the SPR to its lowest level in 40 years and lower its all-time levels in days of supply. They're basically saying it won't really help things structurally, but I disagree. I think that 6 month window will give enough time for production to get up, and if they back off with these type of regulations, we could have all the regulation that we want, all of the production that we want, be energy independent, and be beholden neither to OPEC nor to Russia or OPEC plus, and just flourish as we were doing previously. So, out of every crisis comes opportunity. Hopefully, they'll use it in the right way. Moving on to China. So the China factories have set up bubbles to ride out the COVID lockdown. So as much as the Shanghai lockdowns of 25 million people in shifts, they're not doing it all at once because they want to keep the economy going because they've got to juice it ahead of the China National Congress. they are putting the factories in bubbles so they don't affect the supply chain. And so far, it seems to be working out well. There don't seem to be as many supply chain disruptions as in previous lockdowns, so that's a positive thing. This shows the Hang Seng's forward price to earnings ratio. This is from S&P Global Market Intelligence via Wall Street Journal article. And they're talking about China tech stocks are back. Their glory days aren't. Well, that, again, just like drilling wells, it doesn't happen overnight. They had a heart attack last summer with the crackdown. Now they're getting off the table. They're going home in their wheelchair. And sooner rather than later, they'll be up and walking once again. But they say the key turning point was a supportive message from a meeting of policymakers chaired by China's economic czar Liu He. And this is a signal that policymakers probably don't want to see the market go lower. So that's absolutely right. The CCP put is in place. We know the strike price. Given as easier. Okay, they don't want to see the market go lower. Definitely not in the stomach-churning fashion that preceded the abrupt turnaround. Economic stability is a policy priority in 2022, given that, this is what we've been talking about, President Xi Jinping will likely seek a precedent-breaking third term as the Communist Party's head this fall. It helps that Chinese stocks are already trading at historically cheap levels. China's Hang Seng Index is trading at 8.6 times forward earnings. Okay, compared with a 10-year average of 10.3 times, according to S&P Global Market Intelligence. Alibaba's increased its buyback program. Xiaomi is going to do the same, et cetera, et cetera, et cetera. So market's probably found a bottom in the near term. Returning to the glory days is a different matter. We'll see. But you can see basically at all of these levels, this is even lower than the 2008 crackdown. Then you had the 2016 crackdown was the same time. That was also with the oil collapse crisis, if you remember, and the high yield crisis because of all the high yield debt was in effectively oil companies. So these are levels where if you bought, you were a huge winner, and this time will be no different. And this is very consistent with that price to book chart that we put out multiple times in the last month or so, talking about the violent rallies that come in the 12 months following Hang Seng trading at a discount to book, which it did during this spike down, and it's just started to retake that. And we would revisit lightening up when it's trading at 2 or 3 times book, or in the case of this metric, forward PE, 12 times is where we start to feel the froth, and probably 13 or 14 is where we're dumping everything. So it just gives you some benchmarks. It's not only knowing where you're getting in, it's knowing where you're getting out, and it's knowing where you'll be selling to the optimists. Okay. Xi battles distrust by global investors burned in China before. Capital flight intensifies amid concern over Russia ties. Beijing is seeking to stabilize the economy amid COVID outbreaks. So he's got massive self-inflicted headwinds at the exact wrong time. And what this is going to cause them to do is they're going to dramatically overshoot on the stimulus. So they started in November. We started to see it in retail sales. They got this Omicron breakout like we had in January. They got it on a delayed basis. The difference is they have no real immunity because they've always had lockdowns. So it's going to be more pronounced, but they have licensed the Pfizer pill, the COVID pill that you take within 3 days. So once they get those out, they're probably going to alleviate, I would say, by May or June, these rolling type of lockdowns. And people will go about their business and they'll just have these generic pills from their local producer that they can take once they get it, and they'll just focus on massive testing. And once that happens and their business opens up full tilt and their economy opens up full tilt, plus you've got, remember, everything happens on a lag basis. What you get is just an insane amount. They're going to be giving the patient an insane amount of medicine because they're just going to start to barely see the effect of what they started in November in March and April. So they're going to double down to try to get the economy juiced by November. And by next year, you're going to see inflation out of control in China, likely, after they've juiced the market completely. So, but if you look at the outflows from onshore stocks, remember, opinion follows trend. So the trend has been down. So everyone dumped at the bottom. You can see the outflows are the worst that they've been since the pandemic lows. And that was an unbelievable time to buy. You got one of your biggest rallies from the pandemic lows to the February 2021 highs. And we like stepping in at those levels. And we've talked about what we've done in that regard during that week of complete chaos, which was a week of complete opportunity. Out of chaos comes opportunity. That's probably one of the most important things you can learn in this business. Okay, moving right along. This was a note. Oh, okay. We'll cover that. Okay, China pledges to stabilize economy and plan for uncertainty. Cabinet vows to support foreign investment in state bonds, acknowledges increasing downward pressure on domestic economy. Cabinet vowed to stabilize the economy, called on officials to avoid measures that harm market expectations as the government struggles to control COVID outbreaks across the country, including the financial center of Shanghai. State council meeting on Wednesday with Premier Li Keqiang called the nation to prioritize stable growth and to draft contingency plans, according to CCT, China Central Television. The meeting pledged to stick to the goals set for this year, including reaching 5.5% growth, even though downward pressure is increasing. So if they're sticking to that plan, pressure is increasing from the COVID outbreaks, they're going to have to double the stimulus. There's no question about that. And the central bank similarly vowed to provide more support to the economy in a separate statement issued after a quarterly meeting of its Monetary Policy Committee. People's Bank of China reaffirmed it will step up the magnitude of monetary policy and make it more forward-looking, targeted, and autonomous, according to the statement published late Wednesday, with intensified headwinds to growth from local COVID outbreaks and policymakers sticking to full-year targets. We think the urgency for more policy support has increased, Goldman Sachs Group economists led by Maggie Wee said in a report. The economists expect more central bank easing steps, including cuts to policy interest rates and the reserve requirement ratio. Okay, policy transmission. PBOC also vowed to improve the transmission of monetary policy, which may be a response to structural imbalances in credit growth over recent months. Goldman economists said short-term bill financing and loans have been growing faster than long-term loans, indicating sluggish credit demand and ineffective financing to support investment. Top financial leaders committed early this month to easing regulatory crackdowns, supporting property, and stimulating the economy through monetary policy. To expand investment, the cabinet also called for better and faster use of special bonds and pledged to support foreign investment in government bonds. And and that's that. Shanghai offers 140 billion yuan lifeline in tax rebates, rent exemptions, and financial subsidies to help businesses survive the phased lockdown. This is about 25 billion US. So Shanghai authorities offered 100 billion yuan in tax rebates, range of fees, exempted certain designated companies from paying rent for 3 months, instructed banks to offer low-interest bridging loans to help companies whose businesses were hurt by the city's lockdown. It's about $22 billion, not $25 billion. My bad. Round math in my head. And that's the story there. So they're pumping stimulus in. The other thing that's also got them hugely, the other reason they did an about face, besides the fact that opinion follows trend and they panicked when price got down that low, is that the week before that about face in government policy, Tencent, Alibaba, announced that they were cutting about 20% of their workforce. That's generally good for the stock. It's generally terrible for the government. And that's going to, help their margins, and they're going to come back as growth resumes with all the stimulus that's in the pipeline right now, and it's going to start to be felt in coming months. They're going to be doing so in a much leaner operation, so that's all going to fall to the bottom line, and you're going to see profits start to beat expectations in a major way because they have less overhead, and they're getting all the benefits of that stimulus. So the government's hand was forced, and I said that when they did the education lockdowns, that they were going to have another Tiananmen Square if they weren't careful. That was 300,000 jobs. Now, 5-6 months later, lagged effect of really I would say not well thought out decisions is their major companies starting to lay off in large size. I think Baba's was like 39,000 people, Tencent probably somewhere in the same neighborhood, and that's a big deal. The government now has to figure out what to do with these people, and going into a government transition, that's not a positive thing. So expect more and more and more stimulus to get these people back to work. Here's an article from Matt Booker at Bloomberg, and he's basically just saying, on a range of measures, the MSCI China is close to its weakest relative to the MSCI All-Country World Index in 5 years or more. By price-to-book ratio, the Chinese gauge is at its cheapest compared to the global measure in more than 2 decades. And this shows, so you can just see the last crackdowns. This was 2008, then you had 15 and 16. And invariably, they always recover because the government gets to a point of pain. They get a level of unemployment that's uncomfortable, and their power starts to be at risk, and they start to get lots of dissent and dissatisfied people. And sure enough, they step on the gas and they turn it around, and they turn it around relatively quickly. So from the time they decide, which was just, a week and a half ago. This is everyone panicking at the exact wrong time. This shows outflows. Worst outflows since the pandemic lows, which was a once in 100-year event. And then the last time was at the last crackdown in 18 and 19, and we know what happened next. So that was right before one of the biggest rallies up to February 2021. So history doesn't rhyme, but it just keeps repeating, and we try to take advantage of it the best we can. China PBOC vows to boost confidence, support the economy. This is just more of easing. So affirmed it will step up the magnitude of monetary policy. Okay. Same article, different author. And then this is from the guy who runs the KWeb China Internet ETF. It's called ChinaLastNight.com. In the midst of chaos, there's also opportunity. Sun Tzu, The Art of War. And this is where he's talking about the Holding Foreign Companies Accountable Act. And he makes an important distinction. The Tuesday night, Senate passed the H.R. 4521. Unlike the House's version of the bill, the Senate's version did not include language shortening the Holding Foreign Companies Accountable Act delisting window from 3 years to 2 years. He searched the 2,300-page bill for related terms and found none. Since the House version includes an accelerated delisting, I'm being told by our DC policy research firm that there will be a negotiation on the disparities between the bills. It is interesting that the language was left out, as one could speculate it was dropped intentionally so as not to disrupt ongoing negotiations between the U.S. and China regulators. Shortening the Holding Foreign Companies Accountable Act window from 3 years to 2 years would be highly problematic and an unmitigated disaster for U.S. custodians and broker-dealers that do not allow or are not set up for ADR conversion. My assumption is that the cooler heads in the Senate remove the language so as not to throw a wrench into negotiations. Smart move. We'll continue to monitor the situation and provide updates. Yeah, I mean, this is getting beat to death. I mean, even today, Baidu was added to the list. They're all going to be added to the list. I mean, I don't know why this is like Chinese water torture. Just put every Chinese ADR on the list. We all know that the delisting, we've had a year to prepare for it and get into Hong Kong shares. But there's, more from China this week saying that they found a way to do it. Basically, their way to do it is that, so here's Baidu was the last one added to the list today, so that dragged the whole thing down. Like, why these are surprises is beyond me, but it's also probably end of the month rebalancing for funds that got hit with it this quarter. So there is talk of the Chinese government basically said they're willing to comply with the U.S. regulations as long as their regulators see the filings first, because they don't want any personal information leaked. So they're getting there. They're going to get it done. It's just going to be this, on again, off again. But the stocks are going to work themselves higher. And as I said 2 weeks ago, it will be in fits and starts. But the intrinsic value is now going to be realized because they made the decision that the pain was over. They were going to pull the knife out of their own heart and start to heal and recover, and that's exactly what's happening. Investor redemptions from China funds hit pandemic high. That was the exact wrong time to be redeeming last time because it preceded the largest rally, one of the largest rallies in history. That was when Alibaba hit $315. And right before that, in the 9 months before that, in the middle of pandemic, is when everyone was redeeming at the levels that they were recently redeeming at. Opinion follows trend, selling in the hole at the exact wrong time, more of the same thing. Alibaba just increased its bet on an augmented reality glasses maker. The stock is rising, so they're doing a metaverse play. They're going to be in everything. I mean, they're just, they're part of the FANG of China. There's just no way about it. There's going to be second largest economy in the world. There's a few companies that control the whole thing, and it's the exact same thing in the U.S. That's not going to change. Buyback authorizations moving on to the U.S. markets. Get ready for $900 billion of stock purchases this year, says Goldman. Here's who's buying. Well, the number one thing which we've been talking about is the record buyback authorizations for 2022. When rates were low during the pandemic and credit was abundant because it was backstopped by the Fed, companies reliquified their balance sheets at very low cost, and they're going to put that money to work. And you're seeing that right away. All of these authorizations are going to start to be utilized, and that's going to be the floor for the stock market. And like we were saying 2 weeks ago, when hedge funds were selling at their highest rate since 2008 in the hole, that a few months out, we'd be looking at new highs. Everyone thought I was crazy. We're halfway there. So I think we're going to see things start to continue in that direction. Market bull Tony Dwyer says fears of recession driven by bond yields are overdone. So he's talking about, so look, the most important part of the curve is the 210 spread, period, over and out. So now that the 210 spread inverted on an intraday basis by 3 basis points for 2 minutes, everyone's saying, well, the 210 spread really doesn't matter. It's the 310 spread, 3-month, 10-year spread. No, it's the 5-year, 30-year spread. And now Tony Dwyer is saying, no, it's the 3-month, 5-year spread. In theory, what he's saying is kind of accurate because the average home loan is like 5 to 7 years, and they get the money, for free at the short end of the curve. So 3-month, 5-year does make sense. So he says we don't look for a recession because of that yield curve that's driving the lending is still very positive. The 5-year, 3-month. Okay. Dwyer acknowledged the worth of the indicator, the 5 to 30 and the 2 to 10, but suggested the reaction could be overblown. I think the biggest fear that it's overstating at this point is that the 210 flattening or the 530 year, I understand why we use that and it's very useful at times, but he said the 5-year, 3-month yield actually shows a positive picture because it's steepened, which typically signals expectations of stronger economic activity. 470. Okay, so Dwyer noted the yield curve is important because it reflects the difference between how much interest the lending institution pays on deposits, cost of capital, versus how much it gets from lending or other investments. He said since February 2020, $4.75 trillion has been put into commercial bank deposits. By the way, it's been like $6 trillion printed, and $3 trillion of that has not even been deployed in terms of total stimulus. So that's also kind of a backstop for the next 6 to 12 months for the economy, is that extra $3 trillion that's been approved, that's not even yet fully in the economy. And he said the average duration is about 6.5 years, so we're using the 3-month and 5-year. Okay, there's market seems to be almost pricing in a recession trade because the areas that should do the best with higher rates have been lagging, and the areas that should do the worst, bank stocks, they're doing better. And I think that's reasonable, actually, that they're doing better, because GDP growth is going to slow. It's gone from 6%. We bought the cyclicals ahead of the 6%. Now we're going back down to 4% and then back to trend next year. And that's where some of these tech, particularly biotech and China tech, are our favorites, are going to outperform in that slowing general environment, despite the fact that it's still above trend. Next one, JP Morgan's Kalanovic sees 3 reasons for more stocks upside. If anything, there's too much negativity rather than too much complacency in markets. Kalanovic and his team wrote in a note to clients sticking with pro-risk stance. They say 3 reasons. Number 1, both equity and credit markets have historically fared well at the start of monetary tightening cycles. We've covered that in recent weeks. Even as nominal bond yields rise, the average return, I believe, is 11% in the first 12 months after the first hike. Even as nominal bond yields and rates rise, the real policy rate is extremely negative and thus stimulative. It's too early to take inversion as a signal of recession risk. And finally, not all central banks are tightening, as the Bank of Japan and People's Bank of China are moving in the opposite direction, and equities look likely to see some support from fiscal stimulus in those countries. Not only fiscal, but monetary, and China is really stepping on the pedal. Bank of Japan stimulus is simply in the form of quantitative easing, because they're just buying every bond in sight to keep the 10-year yield below 25 basis points. In terms of China, they are aggressively architecting a recovery, ahead of the China National Congress, and that's why each 5 years we see the MSCI China. It collapses in the 24 months before, when they crack down and assert their regulatory authority to show that communists rule. And then they realize they overshoot and they juice the economy in the 12 months into the November meeting like clockwork. They do it every time, and the same thing's going to happen, and it's starting to happen this time. So you can fight that or you can join it, but that's what's happening. The other thing is... JP Morgan is kind of disputing. So Bank of America has been negative, and Mike Wilson's been negative for 6 months of the rally over at Morgan Stanley. He said, JP Morgan saying to discount that economic indicators are so far beating expectations, and that's too early to position for recession. We agree. If you look at the economic surprise index, it was at 54, I think, its most recent print, which was the second highest. Before that, it was 60 since before the pandemic. So that's a good thing. In over a year, rather. And these positive economic surprises are likely to translate into earnings surprises in the coming reporting season. We're seeing that with earnings estimates continue to go up while everyone's calling for a recession. In fact, with forecasts projecting a large sequential decline in S&P 500 profits, the hurdle for coming earnings reporting season, which kicks off in about 2 weeks, seems rather low. We agree. And always like to listen to what Kalanovic has to say, as well as what Tom Lee over at Fundstrat has to say. And I like his take on this. It's definitely unconventional, but I'm inclined to give it the benefit of the doubt in the short term. He's talking to 3 reasons why stocks can move higher in the face of an inverted yield curve. So investors are treading carefully after the 10-year, 2-year yield curve briefly inverted on Tuesday. And here are his 3 reasons. First, while nominal interest rates inverted on Tuesday, real interest rates didn't. So he's mirroring what Kalanovic said. In prior yield curve inversions like 2006 and 2019, both the nominal and real curve became inverted. Real interest rate curve is still in normal shape. Okay, and what he's pointing to, it has to do with the difference between nominal interest rates and real interest rates, which accounts for the current rate of inflation. So, and what he's saying is it's because inflation remains elevated while the 10-year yields are around 2, while the 2-year and 10-year Treasury yields are around 2.4%, accounting for inflation rates, they are actually in negative territory. Second, backwardation of inflation curve implies that the market sees inflation as episodic, we agree, according to Lee, which can be seen in leading indicators like the Cass Freight Index, which we covered Tom Lee's post last week. Cass Freight Index, backup volumes at ports, and car inventories rolling over. So these are all positive and are pointing to an alleviation of inflation in the second half. We love Tom's work on that front. And the episodic waves of inflation have been driven by supply chain disruptions, revenge spending by consumers on, and I would add, on goods. Now the revenge spending is going to go to leisure, so that's going to take some pressure off goods. We've been saying that publicly for a number of weeks as the economy opens. And now the ongoing invasion of Ukraine by Russia, which has led to a commodity price surge, again, episodic. Finally, the real cost of 10-year money is still negative, which supports risk assets, quote, as real borrowing costs are essentially free, Lee said, and negative real interest rates can lead to an expansion of stock multiples, supporting a further leg higher in stocks. The good news is that in 2022, we have not seen the severe tightening of financial conditions that presaged calamity in 2006 and 2019, and this shows stocks returns are good when negative real rates, realized rate, and stock market performance. So there you go. That was a good note. So Bank of America says data shows that hedge fund continue to sell equities, again in the hole, and that's very positive because now stocks are going to continue to climb the wall of worry with the war. By the way, someone pointed to, I forget who said it, Buffett made a comment in the past to never short the market during a time of war because there's a level of production, et cetera, that's stimulative to the economy. There was another saying, sell the rumor, buy the cannons, and stuff like that. And we found that actually to be relatively true in this latest saga with Russia-Ukraine. Speaking to the reopening trade, CDC lifts travel warning for the cruise industry 2 years into the pandemic. This is just the beginning. The revenge travel trade is just getting started. BA2 or no BA2, people don't care. It's on with their lives, and that's that. Okay, this was from Mark Hulbert over at Market Watch. And again, so now that the 210 inverted for 5 seconds, everyone's switching curves, and they're pointing to this article. He's pointing to a different article, which was from Arturo Estrella. He's at RPI, Rensselaer Polytech. My junior B hockey coach played goalie for them. They've got good hockey up there. And then there was another one by this San Francisco Fed that said the same thing. Basically, they look at the 10-year 3-month, which Jay Powell has alluded to. I really don't care what they look for. I care about what's worked in the past. But given that context, because the 10-year 3-month has steepened, so if you look at before the pandemic, it inverted. Before the last recession, it inverted. During the tech wreck, before the tech wreck, it inverted. This time it's steepening, and that's the point that all these people are trying to make, is that, banks' cost is closer to 3-month than 2-year, and their loans are longer than 5 years. So the fact that the spread is so wide, credit will continue to flow. I'm open-minded to that for the next 6 to 12 months, and then I've got to see economic data continue to improve. If the economic data starts to deteriorate, earnings estimates and a multitude of other indicators that we look for, then we'll just take the 210 as a real inversion and we'll start to prepare for it. 6 to 12 months down the road, we'll be selling into massive strength. Remember, some of the steepest parts of the rallies are after the yield curve inverts. But I'm open to the fact that this could be another 1994. Let's see what this 10-2 yield curve was doing in 1994. Yeah, that's the same thing. It also did not invert in 1994. It was at the lowest it got was 17 basis points. It's now close to 2%. So maybe this is more like 1994. That's been our base case. We'll talk about it more in just a minute with the article of the week. But this is... Okay. So Hulbert's basically saying when the current spread between the 10-year T-note, the 10-year and the 3-month is this wide, the probability of a recession within the subsequent 12 months is below 5%. So those are pretty good odds that there's no recession in the next 12 months. On average, after the 210 inverts, it's 16, 18 months out, you get a recession. So I'm okay with this analysis for now because it wouldn't change my positioning, even if we closed, even if it wasn't just intraday. Let's say we closed at negative 5 basis points and we got a real inversion on Tuesday, and then it restapened. It wouldn't change anything about my positioning for the next 6 to 12 to 18 months. The question is going to be based on the economic data coming in. Do I start to get defensive 12 months out, build cash, get into defensive stocks, and start to put shorts on aggressively? Or is this 1994 and we stay all in aggressive because they've extended the cycle for another 5 years? And I'm leaning towards the latter, but I'm open-minded now given the intraday inversion of the 210s. Now, on a closing basis, if you still look at this, let me just see if I can get today's close. No, it's not up yet. On a closing basis, it hasn't inverted yet. And that was the same thing in 1994. What I was trying to do was get information to see if the 210 spread actually inverted intraday on December 27th or December 28th of 1994, even though on a closing basis it didn't invert. And I've been scouring. The Bloomberg terminal doesn't have intraday data going back that far. So I've been scouring newspaper articles, and the only thing that I found with regard to the newspaper articles was the fact that the 530 spread, which we referenced in one of those articles, if you look here, this is from the New York Times, December 28th, 1994. One sign of such development yesterday was the odd circumstance of the 5-year Treasury note carrying a higher interest rate than the 30-year bond, even though the longer-term bond should, in theory, carry more risk and a higher rate. The yield on the 5-year note was 7.78% yesterday, while the long bond fixed income markets benchmark carried a rate of 7.76. So inverted intraday by 2 basis points in 1994. That's the 530 spread, which we also did. We also did that on Tuesday, but we didn't close inverted. Okay, so Tuesday, the 530 inverted, and actually it inverted in 1994, and we still extended the cycle another 4 or 5 years. So there's a lot of nuance here that we have to, it would be so much simpler if the 210 spread would just close at negative 10. Then we know the countdown clock has started. So there's a lot of nuance here. On a closing basis, the 530 has not inverted. On an intraday, it has. And back in 1994, it did on a closing basis by 2 basis points for, a day or two. And the last time it did this was 2006, before the great financial crisis. So it's not yet done it on a closing basis. So there's some conflicting things. If you look at the 3-month, 10-year in isolation, you say that's very bullish and the cycle is going to go on for a while. If you look at the 210, you say, well, it hasn't inverted on a closing basis, so it hasn't really inverted. And therefore, for all coast is clear. It's 1994. We're going to extend another 5 years. And if you look at the 530, when you see that it happened in 1994, it did that brief inversion and then reversed, just like it did on Tuesday, and the cycle extended for another 5 years. So there's some weight that's saying that, that 2 or 3 basis points for 2 or 3 minutes may not be real, but the fact that it happened means we have to respect it, and we have to be a hawk on the data as the months roll forward. We should, irrespective of whether it was real or not, get meaningful sized upside in the next 12 to 18 months either way. But then the question is, do we get another 3 years after that, like 95 to 2000, which is my general instinct, or do we take a hard breather and have a shallow recession before that next move up? And that would be indicated in data and estimates, and there will be a lot more on that to follow. This was a Wall Street Journal article I pulled up from December 28th, 1994 as well. And it said, for the first time in 4 years, the yield on the 5-year Treasury notes exceeded that of the 30-year Treasuries. So it just acknowledges that, but it does not speak to the twos, whether the 2s or 10s inverted. If anyone can get me that answer documented as to the intraday prices of the 210 spread for December 27th and December 28th, 1994, I will give you 3 months free of the trade service at hedgefundtips.com. It's worth $600. That's how important that information is to me. So if anyone can get it documented either in like a periodical from that day, so it would have been the 28th, it would have been the day after, or the 29th, the day after the 28th, or if you can somehow get the intraday data for the 210 spread, December 27th and December 28th, 1994, it's worth $600 to me. So, and to you. So there you go. It's actually worth it. Hell of a lot more than that, but that's what I'm willing to give you for it. Okay, so to invert or not to invert, that is the key stock market question. For those of you on the podcast, you're going to get cut off in 3 minutes. Go to hedgefundtips.com, and while you're there, click on terms. This is opinion, not advice. And you'll find the VideoCast, fast forward to minute 60, and you'll click play. You'll start word from word where you got cut off on the podcast at minute 60. So here's the article. On Tuesday, the 210 yield curve inverted by 3 basis points for a few minutes and closed with a positive spread of 2 basis points on the day. There are a number of factors that led to this incident, but one stands out from the crowd. Ordinarily, an inversion would be caused after multiple rate hikes, with the 2-year yield climbing along with the Fed funds rate as the Fed attempts to drain liquidity and cool an overheated economy. However, this temporary inversion was caused by an exogenous event, the Bank of Japan. No one's talking about this, by the way. This is important. And this may be another reason why the 10-year and the 3-month is singing a whole different tune than the 10-year and the 2-year, as pointed out by Tom Lee and others. So the BOJ intervened aggressively earlier this week to defend the 25 basis point yield cap by offering to, quote, buy an unlimited amount of government bonds for the first 4 days of this week. According to Reuters, you can click the article here, under pressure from a steady rise in yields, the Bank of Japan lost its defense by making 2 offers in a single day to purchase 10-year Japanese government bonds, JGBs, in unlimited amounts at 25 basis points yield. The central bank then said it would make the same unlimited offer for the next 3 days to make sure investors receive the message loud and clear, but some economists believe the central bank's grip on the yield curve control was at risk of slipping. Quote, markets may more forcefully test the BOJ's resolve to defend the 25 basis point ceiling, which may prompt the bank to modify its approach and allow the 10-year yield to rise more. I doubt it. That'll be a last resort. Bank of Japan's first offer for unlimited bond buying in the morning failed to prevent the JGB from hitting a 6-year high of 25 basis points on Monday, the level the bank has set as an implicit cap around its yield target. Markets are putting the BOJ to the test, so the central bank has no choice but to keep offering unlimited bond buying, said Takufumi Yamawaki, head of Japan fixed income at research at JP Morgan Securities. If yields are allowed to move above 25 basis points, investors will think the BOJ has tolerated a rise above that level. That makes it harder for the BOJ to carry on with yield curve control. Under yield curve control, the Bank of Japan pledges to guide the 10-year JGB yield around 0% as part of efforts to stimulate the economy by keeping borrowing costs low. So what does this have to do with our inversion? Well, in recent weeks' notes and podcast videocasts, I've made the case that the Fed needs to shift to balance sheet roll-off to drain liquidity over more aggressive rate hikes. In other words, they could cool the economy and re-steepen the curve, extend the cycle by multiple years as they did in 1994, as lending is incentivized when the curve is steeper, by doing modest hikes, 25 basis points per meeting, and selling long-duration treasuries on the open market to sop up liquidity. Opponents of this view fear that yields on the long end of the curve would blow out beyond control and our borrowing costs would become unsustainable. I've repeatedly made the case that foreign demand would step in major size between 225 and 250 on the 10-year. Today's action was clear evidence Tuesday's action was clear evidence of this thesis. As managers' yields were capped by the BOJ, foreign demand flowed into U.S. Treasuries at 2.5%. and led to an exogenous cap in the long end of our curve. Simultaneously, the 50 basis points hike rhetoric from several of the impatient and emotional day traders sitting on our Federal Open Market Committee of the Federal Reserve caused the temporary inversion, which did not hold on a closing basis. I mean, what a dumb day to have two FOMC members out pitching 50 basis point hikes in May. It's just the dumbest thing I've ever seen. They really need to let the chair speak and let these other people just sit on the board. There's no reason for them to be on TV with conflicting views every day of the week. It serves no purpose other than ego satisfaction for 7 or 8 members that want to get TV time, and it just confuses the market. There's absolutely no purpose to it. Take your vote. When the vote comes in, you can voice your vote, and then whatever is ultimately decided by the committee, the chairman can present to the market and let the market respond to the final decision, not opinions of disparate people and their emotional day trading accounts, which we saw that they had during the pandemic. It's disgusting, it's unnecessary, and it needs to stop. So anyway, that was self-inflicted pain. Not only do the Chinese do it to themselves, we do it as well. And the FOMC needs to have a little patience on the hikes, as they have so far because of Powell, because at the end of the day, here's the problem, okay? There's nothing the Fed that can do to solve episodic inflation. Number one, are 50 basis point hikes going to make more semiconductor chips and ease the supply chain? Hell no. Are 50 basis point hikes going to stop COVID-19 in Asia so that factories can stay open 24/7 to meet demand? Hell no. Are 50 basis point hikes going to cause a negotiated settlement between Russia and Ukraine? Hell no. Are 50 basis point hikes going to cause our diplomats to complete an effective deal with Iran to bring more supply online? Hell no. Are 50 basis point hikes going to make this administration complete the Keystone Pipeline? Hell no. Are 50 basis point hikes going to make this administration issue more leases on productive land to drill on federal land as producers have done freely in the past? Hell no. Are 50 basis point hikes going to make OPEC pick up the phone when this administration asked them to increase production, as they gladly did when the last administration called to cut production? Hell no. Are 50 basis point hikes going to incentivize our major banks to lend to our energy producers when ESG managers and pension funds force them to limit lending to energy producers? Hell no. And are 50 basis point hikes going to bring more supply of labor online and make more Americans re-enter the workforce and cool rising wages when there are already 11.26 million job openings unfilled? Hell no. So, if the answer to these questions, the primary causes of this episodic inflation, is no, What is the purpose of hiking too fast, causing an inversion, and forcing the country into a recession just 2 years after the last recession, other than to pretend it's going to bring down prices at the pump and increase approval ratings and consumer confidence before the midterm elections? Newsflash, it's not. You can't create oil with monetary policy. You can only effective executive orders that allow energy producers to do what they do best will work. Let me repeat that. You can't create oil with monetary policy. Only effective executive orders that allow energy producers to do what they do best will work. How about an executive order that demands banks lend to energy companies for production? An emergency order that extends credit to producers to produce, to become energy self-sufficient, and put the ESG limitations on hold or on vacation for 12 or 24 months for our national security. So 10-year German bonds have gone from negative 10% and negative 10 basis point yields to plus 74 basis point yields in just 4 weeks. Our Fed's policy is wreaking havoc on central banks around the world as they scramble to hold yields down. Expect more and more foreign central banks to follow the path of BOJ and institute yield curve control in coming weeks and months. This will drive demand for longer duration U.S. Treasuries and give our Fed, if they are smart, the opportunity to lay off some of the balance sheet holdings and move more slowly with the short end of the curve hikes. When the ducks are quacking, feed them. And at 2.5% yield, we can sell it all day long and reduce the size of the balance sheet, sop up liquidity, cool the economy, but keep the short end of the curve low, keep that curve steep, and keep the economy humming. So it's an opportunity to stick save the inversion as they did in 1994 and extend the cycle by a few more years. This is the 210 spread on a closing basis. It has not inverted on a closing basis. So was Tuesday an actual inversion that usually happens naturally at much higher levels after multiple hikes, implying the intended slowing has worked? Or is it a head fake due to the BOJ temporarily forcing managers to more attractive horizons in their demand for yield? We lean to the latter. But even if it were the former, a clear inversion, it would not change our positioning or outlook for the equity markets in the near term, next 6 to 9 months. What was a minority view that we put out publicly a few weeks ago when hedge funds were in the middle of their most aggressive selling in the hole since 2008 is still our base case. We believe the market will work its way to new highs in coming months. 9 reasons to stay the course for now. Sagarika Jaisungan, a reporter from Bloomberg, used to be at Reuters, reached out to ask me the following question on Wednesday. Quote, why are stock markets appearing so sanguine despite the fact that the Ukraine conflict is far from over and at a time when surging costs are threatening profit margins? To which I replied with these 9 points. Number one reason the markets are sanguine is because earnings keep going up. That's all you need to know. The number one reason, going back to Peter Lynch and Sam Rowe's article, the number one reason markets are sanguine is because earnings keep going up. 2022 estimates hit 227.32 this week, up from 225 a month ago. Companies are passing costs on to consumers. Positioning just 3 weeks ago among hedge funds and institutions was its most pessimistic since 2008. Now they have to chase, and that's going to continue in coming weeks. Many indicators are starting to point to an alleviation of inflation. Commercials are starting to sell grains. You can see it in the Commitments of Traders report on soybeans and on corn. We went over that in recent weeks. 2, Russia has limited its focus to the Donbass region, which will likely result in a negotiated settlement. 3, the U.S. rig count continues to climb off the pandemic lows. And again, this 6 months, I got to say, this is going to buy them time. They'll probably get back to this pre-pandemic rig count on that basis. 4, consumers are shifting spending from goods to services, revenge travel, which has alleviated some of the supply chain bottlenecks. You can see, with the exception of 2 days ago, even 2 days ago was at 85% of 2019, but all the other days are over 90% of 2019 travel levels, and I think a few of them even exceed, and that's before the vast majority of business travel has come back online. So, yeah, they're all about 90%. None of them have exceeded, but they're all, within 100, 200,000 over 2 million, which is amazing. The Cass Freight Index has rolled over, pointing to a drop in inflation for 2H. Hat tip to Tom Lee at Fundstrat. We also posted this on a tweet. China is engaged in one of the most aggressive fiscal and monetary easing periods in years, which started in November. The CCP will do whatever is required to juice the economy and stock market prior to the China National Congress transition meeting in November, just as they do every 5 years. An average return of MSCI China in the 12 months leading into China National Congress meeting is 31%. 7, the 210 spread is not inverted on a closing basis as of this time. 8, once a negotiated settlement is reached with Russia, Ukraine, and Iran nuclear deal will be reached with the U.S. This will put another 1 to 1.8 million barrels per day back on the market within 6 months. And finally, last month's job report showed average hourly earnings start to come in lower than estimated, which by the way, gave them cover to only do 25 basis points. We expect that will be the same this Friday. As labor comes back online, this Friday meaning tomorrow, as labor comes back online, wages will stop going up so aggressively and cool some of the overheating. And finally, managers will have to continue to panic buy equity in coming weeks as they get too pessimistic in their February-March positioning. On Friday, I joined Lauren Seminiti on Fox Business, the Clayman Countdown, to discuss whether we were headed towards a recession. Thanks to Ellie Tarrant, Lauren, and Liz Clayman for having me on. I said here we don't have to predict it, just wait for the yield curve to invert. And we just discussed whether that was an inversion or not. We discussed what the Fed should do in terms of the balance sheet versus hikes. For now, the economy's hitting on all cylinders. Unemployment's still at 3.8%. Earnings continue to grow. Record buybacks. We've covered all that. And then we put 2 picks. A.O. Smith. They do residential and commercial water heaters and boilers. We only have 1 month of housing inventory despite the mortgage rates going through the roof in the last month. And prices being high, we still only have 1 month supply. So that supply is going to come on from the home builders in coming years. 72 millennials, average age 31. That thesis doesn't change. The reason that the cost of capital is going up is because there's a demand for capital, and that's not going to change. So I do think what I said maybe 6 months ago is that the starter homes are going to be smaller, like in the 70s. So like, not everyone needs to live in a 4,000 square foot or an 8,000 square foot house. Most starter houses for the baby boomers coming out of World War II, which this era has a lot of similarities to in terms of economics and demographics, were like 1,000 square foot slabs, 1 level ranches, Levittown, think Levittown, 1 garage, 1 door, and 3 bedrooms, 2 baths, all on 1 floor. They can make those, and that'll cut the housing cost in half. The average house now is whatever it is, $1 million. You can get starter homes done at that size for $300,000, and even at 7%, everyone can afford them. And that's where the demand is, by the way. And then 3M, very cheap at these levels, trades at 13.5 times next year's earnings. They got hit with supply chain stuff due to factory shutdowns and a scare that they're going to need less masks. But that's a small part of their business anyway. They're diversified, safety and industrial, transportation, electronics, healthcare, consumer. Their average multiple is 18.5 times over the last decade, trading at 13.5 just on those short-term supply chain and mask issues. And this is a huge compounder. They've compounded capital. Return on invested capital has been 20% a year for the past decade. It's a bargain at these levels in our view. Then on Cheddar, I basically went into all the reasons why oil may have peaked. And then sure enough, we got this announcement today, which I think is going to be the bridge to moderate things just in time for the election. So definitely read this. Great interview with Alicia. This was the technical inversion intraday. Liz Saunders pointed that out in real time, which was very helpful. And then in recent days, a lot of ink has been spilled on what the yield curve inversion means. By the way, Liz Ann Saunders, if you don't know, she's the head strategist over at Schwab. Assume that, what the yield curve inversion means, assume that the momentary intraday inversion captured above counts as a full inversion despite the exogenous events we described above. What happens next? Well, Liz Young is the strategist over at SoFi, and she says since 1977, there have been 8 yield curve inversions. The S&P's average return in the following year was plus 11.5%. If you add dividends in, it's plus 15.2. That's a valuable piece of information. Ryan Dietrich, he's the head strategist at LPL, always puts out tremendous stuff, shares with the community. Looking at the previous 4 times the 210-year yield curve Inverted shows the S&P rallied for another 17 months on average and gained 28.8% until the ultimate peak. So if you sell on the inversion, you miss the steepest part of the yield curve is the message there. And then finally, there was data here from Invesco via MarketWatch, which I found to be the most valuable in terms of just because it went back the farthest. And what it basically shows is the average change in the S&P 500 since 1965 for every inversion. The S&P gains on average 19.13 from the inversion to the peak in the market, which the market peak tends to be on average 18 months after the inversion. So you got another 18 months, another 20% upside, which means some stocks are going to be up 50 and 100% if you pick the right ones. And then the recession starts also at the peak 18 months later. So while a good indicator of future economic woes, an inverted yield curve has not been a very good timing tool for equity investors. For example, investors who sold when the yield curve first inverted December 14th, 1988, missed a subsequent 34% gain in the S&P 500 index. Those who sold when it happened again in May 26, 1998, missed out on 39% additional upside to the market. He said, in fact, the median return of the S&P index from the date in each cycle when yield curve inverts to its peak is 19%. See table above, going back to 1965, et cetera, et cetera. Now, quote, the 3-month 10-year spread is seen as even if only slightly more reliable and has been more popular among academics and noted researchers at the San Francisco Fed. You can click here for that study that they did that I referenced earlier. And this shows just how, where is that? This shows just how steep the 10-year 3-month spread is, which, looking at in isolation, you'd say we're, early day cycle, potentially, but we don't have to make those hard decisions for another 6 to 12 months. In the meantime, we expect new highs. Callie Cox, who's a strategist, I believe, at Ally Financial. Let me just double check that. Ally, A-L-L-Y, I think. She put the part of the curve you focus on also matters, especially today. Yes, the 210 spread is close to inverted, but have you checked the spread between the 3-month and 10-year yield? 1.8%. It's telling a different story. The 3-month 10-year curve tends to reflect more immediate stress for the economy, and it's also fallen negative before each of the past 6 recessions, not even close at the moment. So that's valuable information from Callie at eToro. Okay. So, quote, and Fed Chairman Jerome Powell earlier this month expressed a preference for a more short-term oriented measure that measures 3-month rates versus expectations for 3-month rates 18 months in the future. The 3-month 10-year spread, meanwhile, is far from inverted, Mayfield noted. First, recession or not, stocks can do well immediately after an inversion. The average such return in 12 months is 11%. Second, a 2018 study by the Federal Reserve Bank of San Francisco found the part of the curve between the 3-month and 10 years the most predictive power, and it's still in a steep climb. So the remarkable thing is that the two have always gone hand in hand directionally until around December 21st when the 3-month 10 years started to steepen and the 2s and 10s collapsed, Jim Reed, strategist at Deutsche Bank, said. So this is an odd divergence. Has that ever happened any other time? Looks like the early 80s. Right here. Mid-80s. So that's interesting. Another closely monitored part of the curve has been giving a different signal. Okay, so a lot of people are talking to this. Okay, this shows every 210 inversion since 1900. The further I can go back, the more interested I am to measure these type of things. This is interesting because if you remember the post-World War II boom from 1948 lasted till the late 60s, and you had 2 inversions during that secular bull, and it kept going. And the recessions were very shallow. So this is from Commonwealth. It's widely believed that an inverted yield curve is a harbinger of recession. There have been 28 instances since 1900 where the yield curve is inverted. In 22 of those episodes, a recession has followed, including the fleeting inversion in 2019, followed by the COVID-induced recession in 2020. While yield curve inversion might be a reliable indicator of recession on the horizon, it isn't a very reliable market timing tool. The lag between yield curve inversion and the start of the recession averaged about 22 months. That's when you go back to 1900. But it's ranged from 6 to 36 months in the last 6 recessions. What's more, even when the yield curve inverts, it's a poor signal for getting out of risk assets such as equities. Late cycle is not the same as end of cycle, and equities may continue to offer positive returns. In the 6 episodes of the yield curve inversion since 1975, global equities have in aggregate risen in the 12 months after inversion. Okay, so the AAII sentiment came in neutral. Bullishness was back to 31%. Bearishness was at 27%. But still at the lower end of the range. No type of optimism is seeping in. And that was mimicked by the fear and greed indicator right in the middle, neutral. And active managers are still dramatically underweight at near their lowest level since the pandemic. So they're going to play the chase game. Okay, moving along. Carter put up the earnings for the communication sector. I think there's a lot of opportunity here. They've been hit among the hardest. And the cumulative earnings power of these stocks is up by 1.5% in the last 3 months. This is the top 30 weights. You can see a lot of these hit were tech. I think there's some opportunity there. Let's move on to Stan Fung says, Tom, it's been very helpful listening to your Okay, now we're on to Ask Me Anything questions. So for those of you who don't like Ask Me Anything questions, hang up now. But we've got a lot of good ones. So, very helpful listening to your weekly podcast. And by the way, this has been a long time because what happened this week with the yield curve requires a tremendous amount of analysis and thoughtfulness, and I hope you found it helpful. It's been very helpful. Thanks for spending time on it. I saw the following news and thought you might like to see it. We posted this in our morning reads, and I want to thank Stan for sending it over. This is from the South China Morning Post, and it says, China's financial regulator plans new approach to break the deadlock with the U.S., over the auditing work. Global audit and data privacy principles will be applied in the finance ministry's vetting for state secrets or open sensitive data as personal identity numbers. So basically what they're saying is we'll give the U.S., the PCAOB, U.S. Public Accounting Oversight Board, what they want. We're just going to check it for personal information and pins first. So I think they're getting closer. It's a lot of posturing and nonsense. And, the U.S., the SEC can't say, oh, that sounds good to us in the middle of this negotiation for the Holding Foreign Companies Accountable Act. They got to get that passed so they can go back to the constituencies before November and say, we took on China and we won and now they have to do what we say. It's a political year. It's silly season. Just get used to it. Okay, this is from James. Hi, Tom. Hope you had a great weekend. I'm an avid listener of your podcast and greatly appreciate all the work you put into sharing your opinions, not advice, on a regular basis. I personally follow your view on Alibaba, and it has taught me a lot about dealing with market irrationality, focusing on the fundamentals and sizing positions over time. I currently work at a lesser-known M&A boutique in London, aiming now take the step of switching to my lifelong dream of working at a value-oriented hedge fund to get my foot in the door. I felt your advice of sending over an investment thesis along with CV and cover letter would make the most sense, so I pulled together attached thesis on German software vendor SAP. I'd be interested to hear your thoughts on the play, especially given the current dislocation in European and in particular German equities following the conflict in Ukraine. In summary, SAP is in the midst of transitioning its business model from legacy on-premise perpetual license and maintenance contracts to cloud-based software as a service, which has caused a distortion and apparent slowdown in its growth and margin profile as clunky license sales are replaced with recurring subscription. By the way, exact same story as Splunk in the US, which worked, and it's going to work again. So as a result, the market has discounted the share price to the point that it is essentially assuming sub-inflation growth beyond 2025. If history does in fact rhyme, we should see a dramatic re-rating of the stock as the cannibalization effect of this transition eases and growth becomes more visible, as was the case with Adobe in 2012 and 2013 and Autodesk in 2016, 2017. Lastly, do you have any tips on how to shortlist hedge funds to apply, given most are typically very secretive in their strategies or even their existence? Thanks a lot in advance. I appreciate any feedback and tips you might have. So So James, first off, James put together this pitch book here. I went through it. It's solid, really good stuff. And for those of you wondering how to present an idea, this guy did it right. James absolutely nailed it. And I agree with the thesis wholeheartedly. As a matter of fact, that was a name we almost put in the trade service. We haven't put any size on because we have other tech exposure. But I think it is a bargain down here. And he walks through the different catalysts, and he walks through the valuations and his estimates, conservative, optimistic, risk to the downside, all the basic things that you would want to see in an analysis. Now, he's the point, and here's his discounted cash flow analysis. He puts a euro value at 123, so 140. I think it's trading at 110 USD. Here's his upside. Okay. 34% discount to intrinsic value. That's about right. And it may even have more upside than that. I think he did a great job. I think if he sent this to the top 10 value-oriented hedge funds in London, one of them would meet you. Especially, you should just offer to work for free for 6 months. And then after they see the value you create, they'll pay you. I mean, they just want to see you believe in your work. If you have a personal account and you've had some returns, that's a plus. But this is really good work here. And I don't think you'll have a problem landing on your feet. So just reach out to me offline, and I can guide you in some directions. But go where the crumbs are big. That's one thing that I think younger people could really benefit from is, you could do the same work at a small fund and make a living, or you could do the same work at a large fund and make a fortune. I would choose the latter and do whatever you have to do to get yourself in, even if you have to work in the mailroom for a few months, find a way in. But sending around this kind of work and being able to stand behind your thesis will get you a long way with the right type of partners. And if they're not interested in work like this, it's the wrong fit because they don't think in the same way. So don't bend you to fit them. Find a fund that fits you, and that's why I do these podcast VideoCast. So I attract the right clients for money management, for the long short equity, the same type of mindset, likes to buy high quality on sale, thinks long term, can withstand short term volatility, and that's how you make real money over time. And then and also on the trade service. So there's SAP. I like this thesis. I mean, it could trade down to 100. It really doesn't matter. You could do a starter position here and then start to build up. But I generally think this is a sound thesis. It might be a little bumpy, but I think your 34% up implied upside is realistic. The estimates are really low, which is a problem, but I think you laid out pretty well why they might be underestimating, just was the case with Splunk, because they're looking at a 5-year growth rate of 4%, which is anemic. And so there's a lot to the upside. You look at return on invested capital has deteriorated while they're making that transition. Return on equity has been relatively solid, and it's trading at the low end of its multiple. So I like a stock like that. Good idea. All right. This is from Adam. Great video cast as always this week. In response to your AMA questions, I think you should pick 3 to 5 per week. I get more value from your market dialogue. This was the minority opinion, but it was on the basis of this one that I actually chose to move the questions to the end. The vast majority were like, the questions are the best part. I learned so much. Okay, so this is from Nick Davies. Tom, thanks for taking the time to do the podcast. They are full of really interesting insights into how you think about the market and a great learning tool for us less experienced investors. I was hoping to get your opinion on the airline industry as a secular play and also on EasyJet. In general, airline stocks are still well below pandemic levels, and most have fallen recently given rising oil prices and wider Russia-Ukraine concerns alongside lingering travel restrictions. I am of the opinion that the financials will start to look better this year given the general relaxation of restrictions. I'm looking at this from a perspective of someone who lives in the UK as a revenge travel type of trade. Do you think they might have reached a low point and we might start to see an uptrend over the next few years? I was pretty confident in this view, especially for the short-haul airlines who focus more on domestic routes. However, the rise in oil price and expectation will stay there for longer than we thought pre-Russia-Ukraine has made me start to doubt this a little bit, so I would be interested in your views. One company in particular I've started to build a stake in is EasyJet. They seem well-placed and able to recover demand quicker than many peers. They are a short-haul, largely European-focused airline, so travel is unlikely to be impacted by lockdowns in China, etc. So passenger numbers should be up significantly. Most recent quarterly numbers have hugely improved year on year, with 4 times more flights during this quarter, and Q4 2022 bookings currently similar to pre-pandemic levels. They have protected their balance sheet pretty well given what has gone on. They've maintained vast sums of cash on the balance sheet despite the impact of the pandemic, meaning they can be agile in reacting to future events. They have also hedged 60% oil up to September. They are trading at levels below we saw in March 2020 and at more or less 10-year lows. It's hard to look at them on a PE basis given the negative earnings, but price to book looks now low compared to peers and historical values. Do you think this is a good opportunity, or would you hold off on airlines? Thanks a lot. I would buy airlines. I don't know if I would buy this one, and I'm going to tell you why. What I would do, this is very speculative. Okay, so what you're going to see with EasyJet is that their revenues... So here's what I would do. The number one thing is I would look at the bonds. If the bonds are trading above 80 cents on the dollar, and I don't have European pricing data for fixed income right here. If the bonds are trading below 80 cents on the dollar, I'd probably be inclined to buy the bonds. You want to be ahead in the capital structure for a high risk, high reward thing. If the bonds are at, below 50%, obviously the market thinks they're going BK. I'd probably buy the bonds, take a flyer, you make 100% with less risk. If they go BK, they liquidate the planes, you get something. If the bonds are trading over 80 cents on the dollar, fixed income market's usually smarter than the equity market because they're always looking for downside, where us equity analysts are always looking for upside. Then I'd probably take a flyer on the stock. It's going to take a while. It's going to be volatile, and it should be a relatively small position. But you could have a 2 or 3 bagger. I like more established airlines like United, like Delta, like Southwest. I like some of the cruise lines like Carnival, Norwegian. There's so many high-quality ways to play it. But yeah, if you want to have a couple flyers to make life exciting, go for it. My only issue, I think this is kind of interesting. I got to get the bond pricing tomorrow and kind of decide how I would play something like that. But, I just have to get more comfortable with the balance sheet. But generally, I take a flyer. I mean, it's coming back and it's going to come back hard. Mikhail Bobkoff, Tom, thank you for taking the time to answer so many questions. Could you please expand on why the 210 spread is so important as an indicator of recession? I've also read that the 3-month 10-year is equally good to look out for the recessions. Any preference here? 3-month 10-year has not reached the levels of the 210. Also, you briefly mentioned Boohoo in your previous podcast. What's your opinion on ASOS? I didn't really get set up for ASOS. Let me see here. ASO savings. I don't really want to be in a bank right now with the yield curve flattening. I'm going to take a pass. I can talk to you offline on that if you want more on it. I know like Citi I would buy here because it's a restructuring story. Eventually, if she doesn't fix it, she's going to be out too, and they'll get someone that can do it. But it's trading at like a 30% discount to book right now, Citi or something like that. So if I had to buy a bank, gun to my head, I'd probably buy that here, or wait for the others to come down a lot more. But as we covered in past ones, along with the market, even after the yield curve inverts, because there's momentum in the economy and everything happens on a lag basis, the banks tend to go up with the market until the peak of the cycle. So there could be another 12 to 18 months in banks. I just think I'd want to be higher up on the food chain at this part of the cycle with the flattening yield curve. As far as the 2s, 10s, 3s, and 10s, 3-month 10s, we spent 45 minutes on that, so I think that answered your question. I still think the 210 is the most relevant over the last 100 years. So I'm sticking with that and cautiously awaiting it. So, all right, Howard Carney. Okay, what do we got here? Ask me anything, yield curve. Thank you for everything you've taught us listeners. I found you a year ago while studying for the Series 65 with the dream of opening my own management firm. A year later, and that dream is now a lot more realistic. I will always consider you my mentor, as I could have never had this amazing opportunity to learn so much from anyone else in the business of managing a fund. We have very similar circle of confidence in the cyclical trade, looking for a mean reversion, and our shared interest in out-of-favor stocks. For example, I assumed a bullish position on biotech and healthcare before you confirmed my basis and took your position. However, there is one view that you and that I have not agreed with, which leads me to the question, AMA question. For a few months, you have held the view that the US dollar would be weaker against the basket of the world's currency. You have been right so far, and my losing long US dollar trade reflects that. However, one material thing has changed since then, the yield curve signal. Do you believe that with recent yield curve inversion foreshadowing a bear market in the next 6 months or more, we might see the dollar get bid as investors seek safety? Is it possible that the Fed has reacted too quickly when raising rates, and we will see a bit of an economic slowdown in a year when money is more expensive? Can't wait for the opportunity in the coming volatility of markets. Thank you. Yeah, I think you're probably a little premature on the opportunity. Is probably going to be more like a year to 18 months, if in fact that was a real inversion. We have to see how the economic data comes in. So the US dollar, I just follow what the commercials do. I don't have to guess all this other stuff. I just basically, if they're still getting short, I still want to be getting short. It doesn't work on all instruments, but it does have a tendency to work pretty well. So yeah, here it is. So they started shorting just like here, then it rolled over. Here it stopped going up, at least it was flat, and then it crashed. It's like once they start, after they've gone short and then they start buying back up is when it crashes. So they've gone short, they start buying back up, crash. They've gone short, it started buying back up, and I think we'll probably, maybe you push to 100 first, but I think lower is the area of least resistance, irrespective of all the nice points that you made. So thanks for that question, Howard. Good luck. Tom, I have Wynn Resorts on my watch list. In your opinion, this is from Brady Todaro. In your opinion, what is a good entry point for Wynn? We own Wynn. We love Wynn. I don't really look at it every day, to be honest with you. Let's see. Here is fine. I don't know what you're waiting for. I think anything in this range is great. 80 to 90 is a home run. I think this works its way back up to new highs and beyond. When Macau opens, it's when all the restrictions come down and that pill gets out there, it's going to be through the roof. So, and we covered a little bit on that 2 weeks ago. So yeah, now's a good time. In my opinion, not advice. John Pierce, hello Tom. Ask me anything questions. I vote for 1/3 of the show devoted for questions and 2/3 on the content. Thanks for that. Greg Stewart, a couple of months ago you mentioned that you bought long-dated call options in BABA. The stock was around 75 and you purchased the December 22 105 call option. I know you picked the date after the China Congress, but how did you decide the strike price? It's funny. Carter asked me this question. Carter's my junior analyst. And Presley, by the way, is my marketing assistant who did that video post of the Cass Freight Index that did quite well, and he does a lot of my TikTok posts as well. All right, so Carter asked me this question, and it was good, and I talked to him for a while about it. But the basic thing is when you've been in the markets for a while, a couple decades, you start to know what is natural and unnatural price action. And what we saw in those couple of days when the stock was just free falling to 75 was that that was completely unnatural. It was chaotic. It was disorderly. And that's where I thrive. Like I said, I do a few things really well. That's one of those things. So basically all the action after you broke through 100 was relatively disorderly. So I said, well, let's assume nothing gets better and the regulatory crackdown is still on. It's priced in a lot of the bad news. It's going to grow slower than it's grown historically, but it's still immensely cheap to intrinsic value. So the baseline was 100. And I looked at I didn't want to take more risk on a 20% position, but if I was going to take more risk, how could I dramatically increase the exposure without dramatically increasing the risk? And in order to make it make sense, I said, for every dollar I put out at this point in this chaos, I need, based on the risk, a 10x expected value return on the money. And I think, I think 10x is reasonable. It would imply $184 stock by December. It may be more like a 12x. It may get over 200 if everything goes right. We'll see about these rolling lockdowns, et cetera, et cetera. We've talked a lot about China today. But I think it was 842, some 864 others. Now I think they're $25 or something. I don't know what they closed at today, but they're already up about 3x. But so basically for that 84 basis points, less than 1%, because of the disorder and other funds blowing up and liquidating, I was able to get exposure. It basically grew the exposure by 50%. So it's a notional exposure to 30% from 20% with only putting out 84 basis points more. And because those are now all in the money, that's a real 30% exposure, even though 20.84% of the capital is at risk. So those are just experience and knowing how to pounce when you just feel the gripping and you know that nothing changed in those 2 days. That was dramatically different. It's not like the government came out and said, well, we shut down the education sector. We're now going to just shut down the whole private sector. There were limitations in terms of they could shut down the education sector and modestly get away with it, although now they're reversing course. They could not shut down Alibaba and Tencent and get away with it. They effectively would have to resign from the government that day and move out to the countryside so as not to have a flash mob kill them. So, it was a good risk reward and asymmetry. I'm always looking for asymmetry where I can risk 1 and get 10. And that was one of those nice examples of it. All right, let's do these last couple. Boy, you guys are keeping me here all night. I'm getting hungry. All right, this is from Drew. Oh, Dr. Drew. Okay. A huge thanks for the time you gave to my question on last week's podcast. The expert opinion answer was super helpful. We, your audience, are very lucky to be able to tap into your experience, razor-sharp critical thinking, timely analysis, and valuable opinions on a weekly basis. One area I want to build on is related to something I recall Warren Buffett saying, which is opportunities come in frequently. When it rains gold, put out a bucket, not the thimble. This certainly came to play over the past couple of months. I managed to employ this to a degree, but aspire to getting much better at it. You demonstrated the principle so well with your low basis biotech purchases in 2022. An excellent move at 75 for Baba. I had already invested in Baba at a decent basis before the $75 price, and because of a minimum purchase amount limit over here with the brokers, I would have gone well over 20% in Baba with a further purchase. However, I've taken advantage of biotech now too, thanks, and we'll look at to take further opportunity with Baba to get my basis down, as opportunities will likely be limited going forward. I have a quick related question. Do you generally have a recommended approximate cash portfolio percentage to be able to capitalize on opportunities with a bucket, not a thimble? And how would this typically differ within bull and bear markets? I presume it's partly a balance of being invested enough to make good money versus having dry powder when needed and timing these appropriately. For example, I enjoyed your anecdote of freeing up cash at the last yield curve inversion, and you were then ready to capitalize significantly on the 2020 downturn. Thank you again, and have a great weekend. All the best, Drew. So, yeah, I think you're spot on. So, yeah, I would probably, if I start to see the economic data deteriorate toward the end of this year, I will start to get into more defensive stocks, into cash, starting to look for shorts, but it could still be another 12 months beyond that. So you don't do it all at once. You just get a little more defensive. And maybe, you could, it depends, if you, again, like there's not a blow off, a capitulation bottom in BABA, you see blow off tops in the market where it starts to get crazy town. And that's when you can build the cash up to 20, 30, 50% even. I mean, and then you could even do synthetic exposure. If you're wrong, you can, do general market exposure at 2%, even though you're 50% in cash and that notional value. If you're wrong, that 2% will keep you in line with the market. And if you're right, market crashes, you got 50% of cash, you can go hog wild. So that's just a feel over time. But on balance, you want to buy the dip until the yield curve inverts. The yield curve may have inverted, and then you generally get the steepest part of the equity move in the next 6 to 18 months. I'm being open-minded with this 10-month, 10-year, 3-month. And if anyone can show me that the 210 did invert on December 27th and 28th of 1994, intraday, that would be really helpful, because that would be a key data input in my reasoning over the next 12 months. Shannon, Sabin, 2 things. I love the questions. Helps me understand what other people are asking about, curious about, worried about. Number 2, each week you go through the AAII and the National Association of Active Investment Management. Would you talk about 2 things in this regard? Regarding the National Association of Active Investment Managers, how do you interpret the most bullish, most bearish, and quartiles from the survey, and how about the deviation measure? Look, all these things are to be done with a crayon, not a scalpel. Okay, none of these are magic indicators. I don't signal this one out because it's necessarily better than anyone out. So this jumped up from 55 to 78. So they're still underweight. They started chasing. They're going to have to chase more, and they'll chase back into the hundreds, and then we'll start to assess where we at. If you look in before the 2018 correction, they got up to 120, and then the market rallied another, looks like 10% before rolling over. So we're nowhere near the hundreds yet. Maybe another few weeks as the market pushes towards new highs in the coming months after earnings season starts. Then we'll look to lighten up a little bit. But when it was down here, it's like you don't need deviations. You don't need anything. Just look at the picture. It pays to buy. 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 And that's why we put out those videos every day that no one probably watches, because they want, chewing gum. They like the one-line quotes that makes them happy, but it makes them no money, instead of doing the work and using tools that can actually make the money. But you're different, Shannon. Obviously, you've spent a lot of time thinking about it, and that's my answer. Look at the picture. Look at 30 or 40 of these indicators. They tend to all say pretty much the same thing. If you're closer to a top or closer to a bottom, the ones at the bottom are generally better indicators because markets trend up over time. And I don't take them together. And one is positioning, and one is sentiment, one is institutional, one is retail. But you generally want to take the other side of the consensus at extremes, particularly on the downside, if it's corrected relative to the intrinsic fundamentals of the market, which is largely earnings. And on the upside, you just have to respect that markets trend higher. Second question from Shannon, or second email. Your weekly is great. Your appearances on TV are fantastic, both exceptional because you give arguments and then support your arguments with data. This is in contrast to most of the talking heads you see on TV that say things like, quote, "We're looking at companies that have good multiples and we think they're going to outperform," unquote. Yeah. The problem is we only get to listen to you roughly for an hour each week. So who else is like you? Who do you listen to that gives you an equally cogent presentation as yourself? And more importantly, who gives you a good argument with opposing viewpoint? For example, Kathy Wood does a monthly In the Know video. Thanks in advance for more enjoyable and informative road trips. Cheers, Shannon. Yeah, good question. So, thanks for the compliments. When I listen to stuff, I listen to everything Buffett. I mean, I want to listen to all his annual meetings. I want to listen to all of Charlie Munger's interviews. I want to read their annual reports over and over and over. I always go to the source material. I don't go to secondhand stuff. I try to go to the source. If I want to know about large commercial airline engine producer in Europe, I go right to the annual report. Then I go right to the conference calls. I don't go to someone's interpretation of the annual report or the conference calls. I'll take that into account, but I like to go to the source. I like Kalanovic, I like Tom Lee, and I like Jim Paulson over at Luthold. Those are the three guys that make the most sense to me, and hope that's helpful. Don Gaffney, let's see here. Okay, we covered that. Preference to have the Q&A at the end. So we got through it all. A lot of questions. I think the ones that don't like the questions are relieved they were done in an hour. For the rest of you, I hope you found this very helpful. I'm happy to give the time as people have really good stuff to add and share. And we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.